Hello, everybody. Good afternoon. My name is Leoncio Montemayor, project manager at Solarplaza, and it is my pleasure today to host this webinar, Solar Market Parity in Europe, Challenges and Opportunities. Our two speakers of today will be Tomás Garcia, Director of Business Development at Canadian Solar, and Harry Horner, Energy and AI Coordinator at Climate Connect. So without further ado, let's get started. Okay. So this is the agenda for today, quite a simple agenda. I will start with a brief introduction. Then Tomás Garcia is going to talk about what is solar market parity and what is the current state, challenges and opportunities. And then Harry Horner is going to talk about intelligent energy and a case study from Climate Connect. We're going to finish with a Q&A, so make sure to stick around and ask your questions through the software. You can direct them to both the speakers or just to one. And then we'll finish the webinar by the end of the hour. We're doing this webinar as a prelude to our conference, Solar Market Parity Europe, which will happen the 5th of June in 2018, this year, in Milan. We are trying to have a discussion about the future of solar in Europe. We see that there's a lot of subsidy-free projects popping up in markets such as Italy, Spain, Portugal, France, UK, and Germany. And we will attract more than 200 high-level attendees from around the solar value chain. And we will explore how there are new business models surfacing for solar in this new era. So make sure to register for this event. Tomorrow is the last day of the very early bird pricing. So if you want to get the cheapest ticket, today and tomorrow is the day. We already have our first round of speakers confirmed, as you can see on the screen. Tomás Garcia from Canadian Solar is going to be a speaker as well. And we have 7 other speakers. For those of you who don't know Solarplaza, the mission of Solarplaza is to positively impact the world by accelerating the sustainable energy transition. We do this by organizing high-level events around the world on solar energy topics. We've organized more than 100 events in more than 30 different countries. And we have a growing network of more than 60,000 PV professionals around the world. Some practical notes for everybody. If you have any issue at all with the sound or with the audio, or with the video, sorry, you can use the chat box. And also the presentation slides will be available afterwards, and we'll send you an email. Make sure to put your questions in the question chat box. Okay. So it's with great pleasure that I introduce Tomás Garcia, Head of Business Development, Europe, Middle East, and Asia in Canadian Solar. He has been more than 10 years in the solar industry. He started with First Solar as a market strategy manager, and then he worked for SunEdison as a general manager for rural electrification, and also head of strategy and market development for these areas. And he also has a PhD in physics from Florida International University. Without further ado, Tomás, I'll leave you the virtual floor, and I'll pass you mic and mouse controls, so you can get started.
Yes, thank you very much, Leoncio, for the kind introduction. Thanks also to Solarplaza for giving me the opportunity to present this webinar, and welcome to everybody. So I only really want to give you an overview of our thinking around market parity in Europe, and to highlight some of the challenges and opportunities at the moment. I really only have 3 slides, but one slide describing Canadian Solar. Most of you will probably know Canadian Solar is one of the largest and better known companies worldwide in the solar PV space. Just to highlight a couple of data points, we have about 12,000 employees in 18 countries, listed in the NASDAQ in New York. And as this is in the slide number 10 shows, we have 2 clearly independent business units. On one hand, we have the module and system solutions. Basically, we manufacture and sell PV modules and components, and we are the third largest manufacturer in the world. Only last year we shipped nearly 7 gigawatts. On the other hand, we have the energy group. The energy group develops, finances, builds, and sells solar assets. So we don't typically keep ownership of those assets, but rather sell them to investors. In terms of track record, we have developed and connected nearly 4 gigawatts of solar PV assets worldwide historically, also taking into account the ones done by Recurrent Energy in the US. So solar market parity versus grid parity. I was asked also to clarify this concept. I think it's important to make the differentiation between two different concepts. On one hand, market parity, and on the other hand, grid parity. They both measure how competitive solar PV generation is with regards to other power generation or sourcing alternatives. But there are some key differences to be highlighted. On one hand, market parity compares the generation costs versus other generation sources. It is typically measured or considered at wholesale level. So in power exchanges, on PPAs, very popular these days. And it's, of course, a relevant concept for owners of generating plants or IPPs or utilities. On the other hand, we have the concept of grid parity. Grid parity is actually a comparison not at wholesale level, but at retail level. So it's measured where the consumption takes place, and it can be different whether the consumption takes place at a residential house or a commercial building or industrial point. And it's, of course, more related to the end customers or end consumers of power. So those are two different concepts. Of course, they're very much related, but I think it's important to make the point that they are different. So today we'll be talking about market parity. Moving on to the next slide, number 12. And the key question that we always get asked is, are we there yet? Is market parity already present in Europe? So let's see what drives market parity. In general terms, and of course, this is a very bold simplification of things. There's lots of other factors to be considered here, but I'm just simplifying significantly. So there is two key drivers of market parity that determine whether we are or we're not on market parity. The first one is, what is the cost of generating electricity using solar PV in terms of LCOE, levelized cost of electricity. And the other big factor, of course, is what is the power price at wholesale level that you're comparing to. So with regards to LCOE, again, you have lots of different considerations. I just highlighted 3 here. Of course, CapEx and OpEx are key. Actually, a very important driver. The good news is that these, both CapEx and OpEx, are being reduced. And also an important aspect to be considered is that more or less the CapEx and OpEx are similar across Europe. Of course, a lot of people would say, okay, no, but I don't know, in Germany, labor is more expensive, but tracking systems are cheaper. Fine. But at the end of the day, if you compare across different countries in Europe, the CapEx and OpEx are fairly similar. The other driver, which is also quite has a lot of impact on the financial models, is the cost of your financing, both debt and equity. So at the end of the day, is the WACC, the weighted average cost of capital of your project. In this case, there are significant differences, especially for the price of equity across different countries in Europe, and this has to do, of course, with a risk perception from equity providers and investors. And later on in the presentation, we'll give some hint on what are those costs that we're looking at in the southern countries of Europe. A similar story with the debt, and we'll talk about debt later on as well. And finally, the third factor that really drives LCOE is what is the amount of sun what are the irradiation levels. Needless to say, in sunnier countries in Southern Europe, such as Portugal, Spain, Italy, Greece, there's more sun, therefore producing solar power is cheaper. And the second factor, as I mentioned, is the power prices. Of course, the power prices tend to be common across one country. In some cases, more than one country, as for example, the Nord Pool or the Iberian Power Exchange. These are largely driven by the power mix of the country. So for example, in France, they have a lot of nuclear power that drives the costs down significantly. And this is also impacted by the demand. As we know, the society is getting electrified very significantly. For example, with the introduction of electric vehicles, that will probably have a significant impact. So it's also impacted by the demand. In the particular case of solar PV, we have to be very careful and mindful about this so-called cannibalization effect. This effect does have implications in terms of what is the so-called solar capture price. So what is the price at which a solar PV generation plant will sell that electricity to the power exchange. I have one slide in the backup that explains this effect in more detail. So are we there yet, is the question. So to me, if you ask me, the answer is yes, especially for some of the sunnier countries in Southern Europe. And if you look at the recent news that we have seen in the press over the last few months, with some of these plants actually being built, coming online, or being financed or refinanced, or signing PPAs, it seems that we are at market parity, at least in Spain, in Portugal, and Italy. And of course, this market parity situation will spread out northwise to other countries, eventually covering the entire European continent. So let me move on to the next slide. All right, so a lot of content and ideas in this slide. So here I'm trying to summarize some of the key opportunities and challenges that solar PV has with regards to market parity or unsubsidized solar PV plants. Let me move on to the opportunities first. The first one, to me, it's critical. It's very important, and it's oftentimes overlooked. The fact that we are getting into market parity, or we are in market parity in some countries, really opens a huge market. And this market, very importantly, is independent on any political decisions or any political support and any public support schemes. At the end of the day, this will be a market-driven market instead of a policy-driven market. And that will hopefully ensure a sort of unstable growth. If you think about it, in Europe, only in 2015, of course, this number is about 2.5 years old, we had about 1,000 gigawatts of installed capacity. Out of them, about 100 gigawatts of solar. As we move on to market parity, you can think of solar PV substituting a significant portion of this market. So the market parity situation really opens up a huge opportunity for solar PV across Europe. The second is around lowering the cost of solar in terms of LCOE. As I mentioned, CapEx and OpEx are decreasing. Module prices go down, inverter prices go down, development costs sometimes also go down. So at the end of the day, the full CapEx on your PV plant is being reduced at a pretty fast pace, I would say. At the moment, we are looking at CapEx prices in the range of between 650 to 750,000 euros per megawatt peak. depends on a number of factors, and sometimes this can even include the interconnection and development costs. And these numbers were probably unthinkable just 2 or 3 years ago. So the race for reducing the power of solar PV continues on, and it's just getting it better and better. A third aspect is in terms of the capital available for these type of investments. We see a lot of investor appetite. We see there is a lot of liquidity out there in the market. I get personally calls from a number of investors on a regular basis asking me whether they can put their capital co-development with Canadian Solar, or whether we have plans to invest. At the end of the day, the message is that there is lots of capital available. And that, coupled with the very low interest rates that we're seeing in the capital markets, I think what the result is that the cost of capital, in particular equity, is quite attractive. Of course, solar developers like ourselves would like to get it cheaper and cheaper, but the current levels of unlevered IRR expectations that we are getting from investors, long-term investors, are in the range of 6.5% to 7.5%. And an important clarification to be made here is that these expectations would be for a solar PV plan with a 10-year PPA plus a 20-year merchant risk in a country like Spain or Italy. Another piece of good news is the appetite that we're also witnessing from corporations, their interest to go green in terms of renewable energy sourcing. So many of you will be aware of the RE100 initiative with over 125 companies worldwide already signed up for that. And the intention for these companies is to go 100% renewable in terms of electricity sourcing. This has translated into an increase in appetite for PPAs, of course, renewable PPAs. So we're also seeing how big corporations, especially from the US, but also see many European companies getting interested in signing PPAs. And of course, these PPAs are a key factor to enable solar PV plants in an unsubsidized scheme. Number 5, these new business models open new revenue streams that they were unthinkable a few years ago when we had feed-in tariffs. Of course, we wouldn't need them anyway. But now that we don't have any feed-in tariff or CFDs or any public program, we have to be a little more creative in terms of finding new sources of revenue for our PV projects. Of course, the obvious one is to sell the power, either via PPAs or to the merchant markets. But there might be others that we are trying also to understand, like balancing services, ancillary services for the power market, for the network operators. So these are our new revenue streams that we have to explore as an industry. Another important one is GOs, and guarantees of origin, and RECs, renewable energy certificates. Again, this is linked to the previous point, and these are definitely set to play an important role in the business model. A comment on this: in the conversations that we're having with PPA off-takers, we're negotiating a number of PPAs at the moment. The initial position of off-takers is always to try, and I highlight the word try, to get the GOs for free. Or they say included in the price. We always push back on this. We always say, okay, fine, we will sell you the GOs, but these are going to have a price. And indeed, this price is going to be higher and higher. So we don't want to fix a price now, because we have a strong belief that the GOs will be more expensive moving forward in the future. And the last point I also wanted to highlight is in terms of the development activity. If you look at the Portuguese market, the Spanish market, and more recently on the Italian market, you will see how hectic the market is in terms of people doing greenfield development. So interconnection points are very coveted. Good land plans are also sought after. At the end of the day, there is a bunch of local developers putting a lot of time and money in developing greenfield solar PV plants. Just as a data point, a couple of weeks ago, we learned that only in Spain there is 23 gigawatts of solar PV with interconnection bonds already placed. In terms of the challenges, of course, the picture is not so rosy, and there is some key challenges to be taken care of or to be at least mindful of. First of all, power prices at wholesale level. Of course, some countries, like I mentioned, France, but also Germany, the Nordics, they have low prices. And this poses a significant challenge, especially if the irradiation levels are low. Of course, this will be solved with time. So as time goes by, solar will be cheaper. Power prices will probably be more expensive, so market parity will arrive. But as of today, only the southern countries that are first sunnier and second with typically higher wholesale power prices are the most attractive. And the other one is that in terms of the projections, these, of course, power markets are very unpredictable and oftentimes volatile. Since these solar PV plants will bear a significant merchant risk, understanding the potential future evolution of these wholesale power prices, it's a key aspect. And indeed, at Canadian Solar, we're spending a significant amount of time understanding these things. The second one is in terms of the financing, in particular debt financing. In my view, banks in general are still trying to get their minds around how to finance solar PV plants. In the conversations that we have had or are having with them, the financing terms that they are putting on the table are not really very attractive. They're actually quite different, of course, because the risks are different from the terms that we used to have in the feed-in tariff era. Banks, and this is very understandable, still don't know and are very hesitant on how to deal with merchant risk. So still the financing terms are not great. In terms of corporate PPAs, yeah, there is a lot of discussion and talks and conferences about corporate PPAs. Reality is that, yes, they're coming, but I don't think there are many yet. At least I haven't seen myself many of those corporate PPAs signed. A different story would be with kind of utility-like companies or trader companies. Of those, yes, we have seen quite a few of them. But in terms of big corporations signing PPAs for solar PV, only a handful of them on my knowledge. Another important aspect is the lack of industry standards. So at the end of the day, we don't have any, plain vanilla financing, any plain vanilla transaction. We're really opening up a new market here, a new business model. So we're kind of doing things for the first time. And of course, when you do things for the first time, these things take longer, are harder, and are more expensive. So this lack of standards translates into longer process and higher transaction costs. And the fifth point is about new capabilities. And this applies very much to developers like Canadian Solar, in which we realize that when we're trying to play in this new field, which is the power market, we don't have some of the capabilities that perhaps we need to have. And those are capabilities that typically, power market players have been developing over the last few years. Just a few examples here, like a trading desk, or having forecasting capabilities, or being able even to retail your power directly to end customers. So all in all, there is lots of opportunities, very significant and important ones, but also some challenges to be overcome. So let me stop here. Well, hold on. I have 3 more slides in the backup, Leoncio, that I'm sure you will be able to to share
I
with
think.
the audience, but let me just stop here.
Yeah, thanks a lot, Tomas, for a great and clear presentation. We actually already have quite some questions coming in, so maybe we can look at the backup slides in the Q&A. Would that work?
Perfect. Sounds very
Okay.
good. Thank you very much, guys.
Okay, thanks a lot, Tomas. Just a reminder for all of those who have just joined, you can put your questions through the question box in the software. Sorry, I was mute. Now I'm going to introduce our next speaker, Harry Horner, Energy and AI Coordinator at Climate Connect. He manages the development of AI-driven power forecasting products for the European energy market, which was one of the challenges that we saw from the previous slide. He had some previous roles at Climate Connect as a carbon market analyst and a carbon product manager, and he studied the history and economics at Oxford University. So Harry, I'm gonna send you the virtual floor. I'm gonna unmute you and send you the mouse and the keyboard controls.
Yeah, thank you very much, Leo, for the introduction, and thank you, Thomas, for your presentation as well. Yeah, I think my presentation today will really examine some of the last thing that Thomas talked about, the technologically enhanced business models that can enable and drive the transition towards merchant solar power, well, in Southern Europe and beyond. We think that improved forecasting, the slides come through. We think that improved forecasting and yeah, revenue optimization through AI decision making can really accelerate the rollout of merchant power. And but first, I think it'd be good to give an introduction to Climate Connect. I suspect it's a bit less of a household name than Canadian Solar, and so possibly needs a bit more of an intro. So here on the slide. Sorry, Leo, are you
Yeah, it's yeah, you can use it.
Yeah, perfect. Okay.
Sorry.
No, not at all. Yeah, so on this graphic, you can see some of our price forecasting, forecasting experience more generally, to see how we've got to where we are today. On the left-hand side, you can see some of our forecasting work in the Californian carbon market, and that was really the stems from the company origins. We've also built solar and now wind generation forecast models across Europe and India and parts of Asia as well. We've got about 700 megawatts of forecasted capacity in India, and we've now built up around 250 megawatts of forecasted capacity in Europe. And then finally, we have experience in price forecasting as well. We've developed price forecasting models for the Indian Power Exchange, as well as more recently, we built models for the day-ahead intraday, and they're also in balanced markets as well across several European regions. And it's really this crossover between generation and price forecasting capability, that we think is central to the story of merchant solar power and effective, I'd say, effective market parity in Europe. And this is some of the data scientists that contributed to the diversity of forecasting experience. And we found it's really necessary. I mean, we've got characters who are data scientists, who are financial analysts, engineers with hardware backgrounds, right through to meteorology, and then more back-end technology developers. And we found that the range of team is key to building the more sophisticated forecasting products that are able to link the technical and also the financial parts of the energy business, those sort of crossovers that are now more needed in this government subsidy-free era, I think. And finally, this is the vision that we are striving towards at Climate Connect. And here, in the words of our founder, Nitin Tanwar, Climate Connect envisions a future where the world's energy economy is formed of a web of interdependent, intelligent, and autonomous algorithms, controlling and optimizing every respective node of the modern energy ecosystem. So quite a sentence to get out in one breath. But yeah, this is the 300 gigawatt 2025 vision, where if globally we can get this quantity of generation and load under AI forecasting and optimization, under decisions powered by machines, then we think we'll have reached a point of critical mass, which would lead to an understanding of the independent value of such systems, and therefore speed its global adoption. And now, really back directly to what we're going about, our endeavours in Europe in the solar space. So this is the product that we've built in Europe. It's called Intelligent Merchant Solar, and it's really our answer for where we see the future of solar energy sales going. This future encompassing more energy, particularly renewable energy, traded through shorter-term markets, intraday, and then also right down to imbalance. And of course, direct competition with all other generation types as subsidies fall away. And then also, obviously, as subsidies fall away, if the total revenue, the percentage of total revenue from the energy sales becomes more important, and then the need to maximize this also increases. And also as well, really, that we see the current aggregator model for PPAs. It's really a middleman, we think, where if the asset owners are directly able to access the market themselves, away from aggregators or utilities, then yeah, the asset owners are able to capture a greater part of the value chain, and then yeah, improve and accelerate investment in renewable power. The three parts of the value that we're really targeting with this new service is firstly the imbalance risk that is captured by off-takers in conventional PPAs around imbalance charges. This is where we found it depends on from market to market. Where more development markets occur, such as Germany, we've obviously got much lower imbalance risks, imbalance risk discounts, but anywhere between 3 to 5 of the day-ahead index prices. The second bit of value we're targeting is an increase in revenue through price volatility on short-term markets. And you can see here we've estimated this for our models to be between 10 and 25% of day-ahead index prices. And then finally, there's a very exciting component which then comes from really co-location with storage, where if you're able to shift energy from a low-priced time block to a higher-priced time block and take advantage of imbalance price spikes, you can massively enhance the power of the trading system. And this is obviously, I suppose this is right on the far edge of the current solar market, but we have certainly across the UK and also in some of our pilots across Benelux, we're now seeing interest, if not hardware on the ground, that is now being tendered for this and is looking at being included within a wider solar portfolio to take advantage of this very effect. And so, just trying to bring up the next slide, there we go. So to give some more idea on the product, this is really how we foresee, or a sort of basic architecture of IMS as it stands. And this partners two of our forecasting capabilities that I discussed in the previous slide. So the generation forecast on the left-hand side, which is very established technology for us. This is on a day ahead and then revised every 5 minutes on an intraday basis with increasing degrees of accuracy, obviously, as you come towards gate closure. And then the intermarket price forecast, which is a price forecast suite encompassing day ahead market price forecasts, intraday spot market forecasts, and then imbalance market forecasts as well. And then I suppose the intelligent energy part of this is the decision algorithm between, which we call the trade optimization engine. And this is really a decision algorithm that allocates that constantly revised generation, allocates that onto the various markets as respect to their price forecast. And then finally executed through a partner, through our trade execution engine. Well, across European markets, there's now the ability to trade algorithmically. In the UK, that's oncoming as EPEX makes their transition to a new system. And so, yeah, we found in the development of this that this is very much on the front edge as we've had to overcome obstacles in real time, external obstacles often as well. out of our control. And so I thought it would be good to share with you the results of 2 simulations that we've done for a pilot customer in Belgium and also for a pilot customer in the UK. I've had to redact obviously plant names and the customer names, but the numbers and the generation and everything else is very much real and stated. So to build this, we've taken SCADA data from each of the plants under the 2 studies. This includes injection data, inverter performance level data to forecast the plant, weather monitoring data, and then also the real revenues of the plant. So we benchmarked that against the actual portfolios, the existing portfolios of those two simulations. We've also taken market data from EPEX and from what was BELPEX and what was APX as well to build the rest of the study, and then balance data obviously from the 2 providers there. So on this slide you can see the results of those 2. Both of these simulations, live simulations, have been run since January 1st of this year, 2018, through the first quarter, and so you've got the first for 13 weeks there in total. And you can see here there's 2 very different sorts of portfolios. The Belgian portfolio is a much smaller portfolio of commercial rooftop plants, and so you've got much lower generation, and also we're only taking a spillover generation from those plants as well. And for the UK, it's a very different kettle of fish. It's a ground-mounted, much larger portfolio, or plants, much larger plants. Here you can see the weekly premium here, which leads, if you look at the bottom row here, in Belgium we were able to generate an 11% premium to the PPA through trading between day-ahead, spot and imbalance markets. And in the UK, you can see the premium here is slightly higher at 14.6%. And I would stress that these are initial simulations with models on quite limited data, and we certainly believe that we're able to generate higher premiums than these as we iterate and develop our product. And as we're able to take advantage of imbalanced price spikes more and more, really. But as Thomas mentioned a lot in his previous presentation, there's obviously a huge amount of merchant risk in this sort of behavior, in this sort of business model, which can be antecedent to the banks and other financial parties. And so we really envision that, true merchant to market solar will be preceded by a transition phase of mixed business models. And so for example, for the Belgian plants that we were talking about earlier, we are looking at trading the remaining spillover generation from the commercial rooftops. So we both forecast the on-site usage of the generation, the overall plant generation, and then we are looking to trade the difference. And so that way, much of the plant's financials are covered through the on-site PPA, and then we are able to provide an upside to that, a premium upside that investors can look for. It's the same with corporate PPAs, again mentioned in Thomas's slide. We're working with several large UK bodies in Spain with such corporate PPAs, working with them as well. And then also there's away from actual offtake, we've also found partners who would write essentially hedges or options for a certain percentage of the portfolio generation. And again, this is a mechanism really to ensure that the plant can generate a viable level of revenue to cover its financials, and then we are able to provide an upside, and that's a significant upside through trading, through intelligent trading in that way. And then beneath are some projections, depending on the amount of generation that is floored, what the overall system revenue would be. So if you look at the bottom right-hand side here, quarterly revenue, the PPA provides the lowest revenue, and then if 75% and up to 50 and 25% of the energy is placed on a floor, is hedged at that base limit, and then we are then able to trade ever more of that. And I think this sort of structure really allows, or really caters for a variety of different levels of risk aversion for the investor. We've had some very entrepreneurial, far more aggressive investors that are able to take perhaps a pure merchant to market strategy, and others that are looking at looking at hedging that risk to a greater degree. And so, yeah, I think in conclusion, this is really, although we have developed this for UK and Belgium because of specific customer interest in those areas, Southern Europe is also, I think, ripe for this sort of activity, and indeed it's really a necessary condition of merchant power or merchant to market power in these markets, and it's very much an opportunity that we're looking at targeting, and yeah, providing that capability or that challenge that Thomas was talking about in point 5 of his presentation. And finally, yeah, I would really like to leave you with a question, with a poll. So, what does the audience think is the most realistic business model to enable merchant to market power across Southern Europe? And just to clarify, merchant to market meaning merchant power directly sold to the market rather than through a middleman. And then several answers. So not there yet. Conventional utility aggregator PPAs need to remain. Or B, part long-term corporate PPA, part merchant to market power, which is that mixed option, that hedged option I was talking about earlier. Not the hedged option, sorry, the corporate PPA. And then there was the hedged option, traded generation with an option at a fixed price floor. So this is combining financial products with the trading of the generation. And then finally, true merchant to market power, fully traded, or beneath that, none of the above. So yeah, what is the most realistic business model to enable this transition that we all, I think, can see is very much necessary? So thanks, Leo. Yeah, I think the poll's in progress.
The poll is online, so everybody can vote. I think we'll give around 40 seconds so that everybody can cast a vote. Harry, what do you expect? Do you expect something from this poll?
Yeah, I mean, I'd love to see the population of the audience before answering that. But I think it would probably be, well, in real life, what we're seeing is part long-term corporate PPA, part merchant to market power. So I won't mention names, but as I said, in Spain, we're working with some of the most rapidly developed portfolios out there, and they're looking to place 50 or 70% of that generation with corporate PPAs, and then looking to solutions like ours and others to trade that directly. So I'd say the reality on the ground, not wanting to influence the result, is B.
Okay.
But yeah, there's a range of different investors out there with a range of different preferences.
Perfect. Let's see the results. I think we can see the results right now. So it is in line with what you were saying.
Well, great.
Oh, very interesting. Yeah, none of the above. Yeah, it's mostly part long-term corporate PPA and a little bit, yeah, then divide. There. What is interesting, sorry, is that there's a few people, just 5%, saying that it's true merchant to market, fully traded. So there's always this hedge against merchant.
Yeah, I think that's obviously one of the sort of groups that we're really looking to work with, are those asset owners, for whatever reason, perhaps for the financial structuring of their own plants, are able to take on greater risk and therefore see greater reward as well.
Perfect, great. So I think with that we can conclude your presentation. And we can move on to the Q&A. Yeah, here's my name and my email in case anybody has any questions. We have a lot of questions for both of the speakers, so I think let's unmute both of them. I'm gonna start with a question for Tomas, which I think a lot of the audience is asking. So, between solar market parity and grid parity, is there a case where one can be excluded? So what they mean is basically, if you reach market parity, do you also reach grid parity, or is one independent from the other?
Sure. Yeah, happy to take the question. Typically, To my knowledge, in all the cases, but I won't be able to assert it, the wholesale prices are cheaper than the retail prices. So if you are at market parity at wholesale level, you will be most likely be at retail level as well in terms of grid parity. Now, an important caveat to make here is that the solar PV LCOE at wholesale level, typically utility scale large plants, is obviously cheaper than at residential level or commercial level. But yeah, it can be the case though that you are at grid parity, at grid parity at your rooftop in your house, but there is no market parity at wholesale level.
Yeah, understood. I think that's pretty clear. Thanks for the answer. Lori and Alberto are asking about the capex. Is this capex that you mentioned, is this the all-in figures? I mean, do they include the fees for project rights or developer fees? Sorry.
Yes, I think I mentioned that, and I gave a range on purpose, but the range I gave does include development costs, if you want acquisition of project rights, plus interconnection. These numbers may be surprising to some people because they are significantly low, especially in the lower end of the range I gave. But these are the numbers that we're looking at. And these are the numbers, by the way, that really enable unsubsidized solar in places like Italy and Spain. If you go a little higher than that, probably you will find yourself without a business case.
Okay, so so capex. You said that capex are distributed evenly around Europe, or is there a difference, say, between the Italian market and the Dutch market, for example?
As I mentioned, if you talk in general terms, capex are very comparable at very comparable levels. But if you start fine-tuning your numbers and you start talking about a specific project, of course you will find differences between the capex in the Netherlands versus Spain or Italy. It also makes a big difference in terms of the size plant. So if you're talking about a 100 megawatt solar PV plant versus a 5 megawatts, there will be also significant differences.
Yeah, of course, Okay, a lot of people are also asking about the unlevered IRR, Gregory, Joao, and Ruben. So basically, are these expectations before or after investor tax? And can these expectations be met taking into account the long term, so 30 to 40 years plus the merged risk?
Yeah, so those numbers are post-tax for investors, and they are assuming a 30 years lifetime of a power plant.
So what you mean is that the real return is a bit higher, but this already includes the tax, the 6.5 to 7.5%.
Right.
Okay.
Again, I don't want people to stick to the numbers. At the end of the day, you can play with your financial model and get whatever result you want. I think the message that I want to come across, or to have the audience to understand, is that cost of capital, especially equity, is getting cheaper because there is a lot of appetite and a lot of availability.
Okay. Yeah, I mean, these numbers are just a reference point. I mean, the numbers change between different projects, so it's pretty hard to put all of them into a range.
Exactly.
And this is a personal question from mine regarding corporate PPAs. I mean, we haven't seen a lot of corporate PPAs here in Europe, and most of the corporate PPAs, and if I'm not mistaken, it's around 75% of the corporate PPAs on renewables have been on the northern countries, such as Netherlands and the Nordic countries. Why is there this disconnect between market parity countries, such Italy, Spain, and all these northern countries in regards to corporate PPAs? Why is this the case at the moment?
Sure. Okay. I think there is at least two factors to answer that question. The first one is that, especially in the Nordic countries, there is a lot of hydro generation and wind generation. So those are been typically the sources of renewable PPAs. Of course, not so much solar. And the second part of the answer is that it's a cultural issue, in my opinion. If you look at countries like Portugal, Spain, and Italy, there isn't, or there has not been so far at least, any PPA culture. So corporations were not really used to buy power on a long-term basis. At the most, they would buy, 1 year ahead or maybe 2 years ahead, but not beyond that. I think that is changing, and we are now seeing how this culture is changing, and corporations are also starting to be willing to consider longer terms, 10, 15, 20 years.
Okay, yeah, that makes sense. Thanks. And just last one, I think I'm gonna show the cannibalization effect. If you can explain it briefly before we move on to Harry.
Sure. It's fairly simple. At the end of the day, if you think about solar PV, it's generating in the middle hours or the central hours of the day. So when you have only a few gigawatts of solar PV power being injected into a power exchange, it doesn't make a big difference because the pool is so huge that this is only a small portion of the power. Now, when you start, incorporating more and more solar PV generation, more and more electricity coming from these solar PV plants will be coming online at the same central hours of the day. This will significantly increase the supply, the amount of power available for sale, but the demand will probably be the same. And it's just a question of supply and demand. You have increased supply, same demand, the price goes down. And it's called cannibalization effect because at the end of the day, the solar PV is cannibalizing solar PV power prices.
Yeah. So it's sort of like a paradox in a way that the more solar you add, the less value it has to the whole grid.
Correct. And the good news is there is strategies to work around it, and I think the players like ourselves are getting our heads around how to mitigate this risk.
Okay, thanks a lot. Thanks a lot, Tomas. I'm gonna follow up with some questions for Harry. Harry, one important question is: do you think there is a difference in this percent weekly premium by country? So what I mean is, would you expect different returns in sunnier countries such as Italy and Spain compared to the ones that you showed, Belgium and UK?
Yeah, I think the two main drivers with respect to this is how developed, or how competitive the PPA regime in each country is, and then how volatile its power market is as well. So on the first point, some countries tend to have much higher imbalance charges that tend to be placed on their renewable PPAs. For whatever reason, if the solar market is more developed in a country with more providers of PPAs at more competitive rates, or indeed if there's more solar that is owned by IPPs rather than
I think we're not listening well. Yeah.
Can you hear me? Is that?
Oh yeah, now we can. Yeah.
Yeah. So just to quickly repeat, I think the two main drivers in this is firstly how developed the PPA, how competitive the PPA market is in the country, and then how volatile the market is as well. So on the first side, with respect to how competitive PPA is, if you've got a smaller imbalance, discount, a smaller imbalance charge on the PPA, then we are then able to, well, I suppose, generate less of a premium because the PPAs are in fact more competitive, and we do see a variety of that across Europe in countries that have more solar owned and more solar owned by utilities. They are then often contracted to trade through their trading arm, and therefore offer often a less competitive PPA to that asset. Whereas in countries with more solar owned by IPPs, independent producers, that then often also follows a more competitive PPA market as well. And then on the second side, with respect to, I suppose, trading opportunities, I think this really, it fluctuates with how volatile or how traditionally volatile a certain country's power market is. And so, just recently in the UK in March, we were able to generate very, very significant premiums on our trading model because of the erratic weather and an erratic response of power supply to that as well. And so it really follows the volatility. And so I think you need to trace more volatile power markets, and then that's where this technology, where good price forecasting can really come into its own and take advantage of imbalanced spikes and spikes on the short-term markets.
Okay. And I mean, following up on this, you showed the weeks 1 to 13 in the simulation, right? Which is around 3-4 months. How would you expect to change this within the year? In the summer, for example, or in the winter, it's the simulation that you did. But for example, in the summer, would you expect higher returns, or would you expect lower, or what are your expectations here?
I expect I think we're probably expecting, although our models will improve, I think it will be more difficult to generate returns in the summer months, because that is when solar becomes a more predominant part of the grid, and therefore we compete against more generation. But that being said, I think it's really more about where we allocate, how we trade the generation. So in the summer months, I would imagine we trade more on day-ahead markets and further out, whereas we're seeing a lot more opportunities on imbalanced markets currently.
Okay, and if you collocate the storage, how does this change? Because I can imagine storage would change the whole algorithm, because you can store energy when it's cheaper and sell it when it's more expensive.
It really does extend, and it extends it by a whole another dimension, as you say. You, rather than being mandated to make a decision between where to allocate or which market to allocate generation, you have the time factor as well. And we're working with several solar companies with either with oncoming or currently operating battery plants in the UK, and it's really about that revenue stack that they talk about with battery projects, whereas this partnering a solar portfolio with a battery and our technology then can provide a baseline of revenue, an underlying trading revenue from the battery, a premium in that sense, when perhaps capacity or frequency payments, service payments aren't as available. So it's either about providing that baseline, or indeed then extending the power and the reach of that premium.
Okay, that's clear, and I'm really curious to see in the future when storage is cheaper, how this is gonna change the dynamics at the power market. And a question from the audience, to secure a floor for a long period, like 1 year or more, isn't the floor that you were referring to, isn't this too expensive?
Yeah, we've taken we've actually discussed this and found a sort of pricing array from several different partners, and we've looked and we put this pricing of the floor through our models, and the short answer is yes. We think it's viable. We think we can still generate a premium above this and generate more money than the PPA. But this is, as I say, it's heavily dependent on the risk aversion of the asset owner, because the closer and closer you get to hedging, up to 100% of the revenue, you're effectively entering a PPA at that point. And so it's really how far you want to get away from the PPA, and therefore how much potentially risk you want to take on board. But for us, it's really, I think, about finding the correct blend for each investor, the blend between upside and risk. And as I said, this varies from asset owner, and we want to essentially structure it correctly for each client. And just in our first 4 days, we've got 5 or 6 pilots on this across these markets, and each one is really after a different sort of blend, a different structure. And we're finding that is something we are able to we are able to offer through through being creative, I suppose, through in these ways.
Okay, thanks a lot, Harry. And I think with this question, we're gonna close the webinar. So first of all, I would like to thank our two speakers, Tomas and Harry, for great presentations and for taking the time for answering all the questions. There are more questions that can be answered, so feel free to send me your questions to my email as you see on the screen, and I can forward them to the speakers in case you didn't get your questions answered. Please visit our website, solarmarketparity.com, to learn more about our upcoming event. Make sure the registration, the very early bird expires tomorrow, so make sure to register today and tomorrow. That is all for today. Thanks, everybody, and thank you, Tomas and Harry, again.
Thank you. Cheers.
Cheers. Have a good day.
Thank you, guys. Bye-bye.
Bye-bye.